Markets don't usually break where the pain already is. They break where complacency quietly builds. Right now, an extreme form of market rotation is underway, and it's reaching dangerous levels. Former market darlings like semiconductors and software are getting crushed. At the same time, metals, industrials, banks, and energy are being overbid to the same extent tech once was. This isn't healthy rotation. This is excess moving from one pocket to another, and that distinction matters. Let's start with behavior. We're now in a market where Caterpillar is trading like a biotech stock, and FedEx is behaving like a semiconductor name. That should immediately make investors uncomfortable. These are mature, cyclical, capital-intensive businesses. They do not have explosive growth curves. They do not reinvent themselves overnight. Yet price action suggests the market is treating them as if they do. That's your first signal. Market rotations are normal. Extreme rotations are not. In normal rotations, leadership changes gradually. In extreme rotations, capital stampedes. Right now, money isn't rotating because fundamentals suddenly improved everywhere outside tech. It's rotating because investors are desperately chasing what still goes up. This is not optimism. It's avoidance. Semiconductors and software were crowded for years. Valuations expanded, expectations became unrealistic, and eventually gravity showed up. Instead of reducing risk, the market did something else. It simply changed costumes. The excess didn't leave the system. It just moved. Now industrials are priced like growth stocks. Energy trades like it's immune to cycles. Banks are treated as bond substitutes with no credit risk. That's not rotation. That's mispricing spreading. This phase is dangerous because it feels rational. People say things like, industrials are safe, energy is a hedge, banks are cheap. Those statements can all be true until they're pushed too far. And they are being pushed too far. When defensive or cyclical sectors start delivering momentum-like returns, it's usually a sign that positioning has overtaken fundamentals. That's when drawdowns become violent. Make no mistake, when this rotation stops, it won't stop gently. These stocks won't drift lower. They'll reprice. I would not be surprised to see names like Caterpillar or FedEx fall 30 to 40% over the next several months, once expectations reset. Not because they're bad companies, but because they're being treated like something they are not. This is how markets work late in cycles. They stop rewarding fundamentals and start rewarding whatever hasn't broken yet. Eventually, everything breaks, just at different times. The real risk here isn't any single stock. It's the illusion of safety. Investors believe they've rotated into something defensive, when in reality, they've rotated into the next crowded trade. And crowded trades don't unwind politely. So what should investors do? First, stop confusing rotation with protection. Just because money moved into a sector doesn't mean risk disappeared. Often, it means risk followed the money. Second, watch price behavior more than narratives. When boring businesses start moving like speculative assets, something is wrong, even if the story sounds reasonable. Third, manage exposure. This is not the time to chase what already worked. It's the time to question why it worked so fast. Extreme rotations don't end with everyone safely repositioned. They end with disappointment, just in new places. The market isn't de-risking right now. It's reshuffling risk. That's the signal. This is Market Signals. Thanks for watching.